Hello and welcome to The Week in Markets, a new show from True Potential where we're going to bring to life those key events that have happened over the past week in asset markets. I'm joined today by George Bell, one of our investment directors, to discuss those key aspects. Casting our mind back to Monday and morning markets, we focused in on some of the events that we thought the market would focus on. First of those was inflation, US inflation on Thursday. A lot of weight put on what was going to come there, George. And did we get the right answer, the wrong answer, or was something in between maybe?
It came in a little bit higher than what was expected. If we, it's in focus because it's around a third of where we were when it peaked. And the expectation was we're going to see that trend of falling inflation continue. If we look at the monthly number, then it actually increased by about 0.3% in December. So if we look at headline inflation, which is the broadest measure, that actually moved from 3.1% to 3.4%. If we look at the core aspect, which is stripping out energy and food prices, that did continue to moderate, came in at 3.9% from 4%, but the market was expecting a little bit more in terms of that move lower. Shelter was one of the key components of this.
I think that's an important point really to bring out. The shelter component is about a third of the US inflation basket. So what happens there can have quite a significant and meaningful impact on the overall number. And it probably surprised to the positive, would I be right to say?
Yeah, the shelter component actually increased by about 6% on an annualised basis, which, as you say, Jeff, being a third of the contributing basket, it's quite a material impact. So that accounted for quite a bit of that monthly increase.
And it has been a bit of a frustration as well, in that a lot of the data that we can look at would be suggesting it would have been falling faster than it actually is. It seems to be holding in at that level.
Yeah, it's just hanging around. I mean, the market was expecting, as you say, the roll-off to be coming through by about now, and that would have had quite a material impact in terms of continuing to bring inflation down, but it's just a little bit higher than what was expected.
And when we think about that, really, it's the market reaction to it wasn't significant in any way, and I'm really thinking about how bond markets reacted there.
Yeah, it was. We've seen a bit of movement in the bond market, but if we were to take the 10-year US Treasury bond, it's moved in a range of about 6 to 7 basis points through the course of the week. So the market has taken inflation data, which it would have previously reacted very strongly to, in its stride. It's digested it a lot more.
And I suppose really broadly it still speaks to that trend that's in place of disinflation working its way through. There was nothing really that changed that significantly.
That's right. And if we look at data which is providing more of a trend, if we were to use 6 months annualised data, then it's actually coming in at a level which is below the Federal Reserve's own projections, the projections which they set out only just in December. The market is currently the inflation data is.
And one of the things I suppose that you've talked about there, that we strip out energy costs, one of the areas that has been in focus when we look at morning markets this week has been what's been happening in the oil market. Indeed, a bit more volatility today. When we come in this morning, we were able to see that oil was up about 4% on the military action that was taken overnight.
Exactly. The oil price has been very volatile through the course of the week on geopolitical tensions, but also supply dynamics as well. Saudi Arabia's announcement in respect of how they would be looking to adjust supply and pricing levels has been two of the key components which have been feeding into this. So volatility within the oil market, but big swings, but generally round-tripped.
Maybe to turn the conversation in a slightly different way, but still related to the bond market, we've been thinking about it points through last year, really, the amount of issuance and the shape of issuance that was coming in various different locations, really. This week has seen significant issuance in the UK, US and Europe. It seems to have gone well.
Absolutely. I mean, if we take Tuesday, that was Europe's biggest day on record in terms of bond issuance. If we would just take some specific regions, Italy, they were seeking to raise 15 billion euros worth of debt. The bids actually came in at 163 billion euros. If we were to look at Belgium, they were trying to raise 7 billion. They got bids for 72 billion. It was a massive demand. Even in the UK, 20-year UK gilt, they were looking to raise 3 billion. The coverage was 3.4 times that. So a huge amount of demand for the bonds which are being issued by government.
And again, just really brings about quite not a sea change, but a real change in attitude towards sovereign bonds from investors at this point in time, probably just recognising where yields have moved to.
Yeah, exactly. Investors with cash have been looking at the yields, recognising that interest rates are coming down if we look at the projections, and just taking advantage of those moves. But it's another example of an aspect which will have influenced the bond market, and take the inflation data which we've received, take some of the employment data, couple that with supply which is coming to the market, then in the main the market has digested those movements and those data prints pretty well through the course of the week.
I think one of the other points, just whilst we're on Europe, and you're referencing there the amount of issuance, was really the ongoing economic data that we've taken this week, particularly as it related to employment.
Yep.
And I was quite surprised when we were discussing that as a team when somebody did say it's the lowest it's been since the creation of the Eurozone.
Exactly, yes, 6.4% is one of the lowest levels which we've seen. If you break it open, there is regional nuances. If we were to look at Germany, the unemployment level is closer to 3% versus Spain, which is closer to 11%. And that in itself, some of the challenge which the European Central Bank have got to manage.
I suppose trying to set a policy level for all, but recognising there's vast differences between the dynamics in each of the individual countries.
Exactly. How do you manage that when you've got growth rates, recovery rates, even out of the pandemic, happening at very different levels? And it's one of the reasons the markets moved to the viewpoint that the interest rate hike which we saw out of the European Central Bank at the back end of last year was probably the last one.
And I think it probably is also fair to say that interest rate cycle that we're talking about there in Europe is broadly similar to that which we're seeing in other regions as well. The interest rates have peaked for this level of the cycle. The question now is how much they come down and when they come down for the first time. And maybe if we link that into what we've been seeing here in the UK, a slightly better, albeit anemic GDP number, but maybe the bigger story really this week has been that ongoing change within the mortgage market and how mortgage rates have changed.
Yeah, quite a material move. You know, if we think about mortgage rates, 2-year fixed deals looking something like 4.2%. So that's quite a marked step down from the peaks, which were 6% plus.
Or something, yeah.
So quite a material move. And, why does that matter? It'll be obvious to mortgage holders at home. It impacts how much you've got available to spend, and consumer spending has got such a dramatic impact in terms of economic growth. So any moderation in terms of those mortgage costs are supportive for the future spending and capabilities, with inflation coming down for UK consumers. And if we just take the economic growth data which came out, 0.3% positive. It's quite a weak number, but it's positive relative to the previous month where we saw a negative print, and it was retail spending through that month which was very supportive.
Again, as you say, crucial for the broad direction of economies, links through to employment and many of those trends that we've been discussing as a team, part of Morning Markets as well. But George, thank you for that. That's been a great way to go about and understand what's been the key factors influencing markets in the past week. Thank you to our viewers that have tuned in for the Week in Markets. Please do look out again for the show next week, but also keep abreast of what's happening in asset markets with our weekly Morning Markets video as well.